Have you felt the whiplash in the markets this week? The U.S. stock market faced a turbulent week ending August 2nd, 2025, dramatically shifting from a period of sustained highs to significant downturns. The S&P 500 fell 2.4% for the week, though it's still up 6.1% for the year. The Nasdaq saw a similar weekly drop of 2.2%, holding on to a 6.9% gain year to date. So what's going on behind these dramatic shifts? Today, we're going to demystify that volatility. Economic uncertainty has escalated amid disappointing employment data, significant tariff impositions, and a major shakeup within key government financial institutions. Our mission is to give you a clear, actionable understanding of the powerful forces at play. We'll dive into the weak labor market, the impact of new tariffs, and a leadership shakeup at the Federal Reserve and the Bureau of Labor Statistics. Let's start with the labor market, which showed notable weakness and fueled economic concerns. The July payroll figures were a major disappointment, coming in at just 73,000 new jobs, far below the estimated 104,000. Even more concerning were the massive downward revisions for the prior 2 months, totaling 258,000 jobs. This marks one of the most significant revisions in decades. On top of that, the unemployment rate rose to 4.2%. Layoffs also surged. The July Challenger Jobs Report showed a 29% increase from June and a staggering 140% rise year over year, driven by factors including tariffs and AI integration. Next, tariffs. President Trump's aggressive policies intensified this week, escalating trade tensions. New tariffs include a 35% rate on Canadian imports, up from 25%, 39% rate on Swiss goods, and a broad reciprocal minimum tariff of 10%. This drives the average U.S. tariff rate to approximately 18.3%, the highest it's been since 1934. Major corporations have responded with alarm. Ford anticipates tariffs will be a $2 billion headwind. Apple projects $1.1 billion in additional costs. Procter & Gamble expects about $1 billion in higher expenses, and Hershey announced price hikes, citing anticipated tariff costs of $170 to $180 million. These tariffs threaten corporate profitability, supply chains, and your purchasing power. Amid these anxieties, a significant leadership shakeup heightened the uncertainty. Federal Reserve Governor Kruger abruptly resigned, creating a power vacuum within the Fed. These moves signal potential political pressure on economic policy. The market now anticipates a more dovish Fed, with an 88% probability priced in for 2 interest rate cuts this year and an 80% chance of a cut in September. The Fed now faces the delicate balance of navigating a rapidly deteriorating labor market alongside persistent inflation, which complicates its policy decisions. So, with all this broader market turbulence, how did specific sectors perform? We saw significant disparities. AI and tech had mixed results. Companies like Microsoft and Meta delivered impressive results, benefiting from their AI investments. Apple, however, showed vulnerability due to tariff concerns. Consumer and materials sectors suffered steep declines, impacted by rising costs and cautious consumer spending. Cryptocurrency stocks plunged as Bitcoin prices dropped, with Coinbase declining nearly 17%. Conversely, renewable energy showed resilience. First Solar, for example, gained 5.3%, driven by competitive advantages created by the new tariffs. Geopolitical risks, including ongoing conflicts and escalating U.S.-China competition, add another layer of unpredictability. This past week underscored significant vulnerabilities within the U.S. economy, intensified by policy-driven uncertainties and dramatic leadership shakeups. Given the current environment, investment strategies must emphasize quality, diversification, and resilience. Companies with solid fundamentals in sectors with structural growth like technology and renewable energy continue to attract favor despite the turbulence. While near-term volatility is likely to persist, these disruptions may provide entry points into undervalued assets for long-term investors. Vigilance and adaptability are crucial as the market contends with these evolving risks and shifting economic fundamentals.